Another type of stock a corporation can issue is preferred stock. Is it preferred over common? If so, why? Preferred stock has a preference over common stock in two areas: dividends and distribution of assets. Preferred stockholders are paid first when dividends are declared. Preferred stockholders are also first in line to receive distribution of assets if the company is dissolved. There is one drawback to preferred stock, though. Unlike common stock, preferred stockholders have no voting rights. Issuance of preferred stock is just like common stock, but with a different account name. Assume a company issues 1,000 shares of $25 par value preferred stock for $70 per share. The company would debit cash for $70,000. The company would credit preferred stock for the amount of the par or stated value. In this example, that would be $25,000. Then, the amount paid over the par value would be credited to paid-in capital in excess of par. Some companies use the account name additional paid-in capital. Whichever you like is fine. The credit would be for $45,000. Let's see what happens when a dividend is declared and paid. Assume a company has 5,000 shares of common stock outstanding and 300 shares of preferred stock outstanding. The company declares a cash dividend on October 1st of $1.50 per share to all shareholders of record on October the 15th. The company pays the dividend on November the 1st. On October the 1st, the company would record a debit to dividends for $7,950 and a credit to dividends payable for $7,950. This is calculated by taking the total number of outstanding shares, common and preferred, and multiplying it by the dividends per share of $1.50. There is no entry on October the 15th. On November the 1st, the company would debit dividends payable for $7,950 and credit cash for $7,950. Preferred stock can also be designated an amount of dividends they are entitled to. For instance, if a company issues 1,000 shares of 9% $25 par value preferred stock, the 9% designates the amount of dividends. Each share of this stock is entitled to 9% of the par value, or $2.25 per share in dividends. Assume the company paid $5,000 in dividends. There are 1,000 shares of preferred stock outstanding and 3,000 shares of common stock outstanding. How much does each class of stock get paid in dividends? The preferred shareholders will be paid first and are entitled to $2.25 per share. Therefore, they would get a total of $2,250. The remaining $2,750 would be paid to the common shareholders. This means the common shareholders got approximately 92 cents per share in dividends this time. That amount could change depending on how much are declared and paid in dividends, as common shareholders are not guaranteed a set amount. Sometimes that may work in the favor of the preferred shareholders, and sometimes it may not. Preferred stock can also have special characteristics. It can be convertible. This means that the preferred stock can be converted into common stock. It can be redeemable. This means that the preferred stock can be redeemed or repurchased by the corporation at a set price. It can be cumulative. This means that these preferred shareholders are entitled to a dividend each year, and if they're not paid, as dividends are not required to be paid each year, these shareholders keep up with what they should have been paid. They continue to keep up with these IOUs until a dividend is paid. Once it is, all of this back pay must be paid first before non-cumulative preferred stock or common stock, or even the current year's cumulative preferred stock. What do you think? Do you prefer preferred